It's panic at the top. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the Biden administration faces an unexpected crisis as this just crashed by 60%. And what I want you to understand is I could find no major news network that covered the story yesterday, and for good reason, because when you understand the data and what I'm going to show you, what it suggests is the U.S. economy just hit a breaking point. And for the current administration who's seeking re-election by November, what it also means is they're about to face an unexpected crisis that could send the U.S. economy, as you're about to see, into a recession long before we get to the election. And with that, let's head over to Zero Hedge, where we picked today's story up with a headline: a shocking collapse in credit card debt growth just as APRs hit an all-time high. And that's something I want you to understand, because many people believe that interest rates need to just go higher, and they're going to go higher for decades to come because inflation is going to stay red hot. We're going to make the case why, based on the credit data alone, inflation is coming down. But I want you to understand is there is a supply and demand component for credit. When you start to see demand for loans go down as rates go up, well, what it suggests is that rates are too high. And in a debt-based economy, well, when you have a lack of consumer credit growth, it means your economy is about to take a downward spiral. And based on the data we just got, it means we hit a breaking point. And after several months of wild swings in U.S. consumer debt, culminating with last month's jump in credit card debt to a new all-time high, despite record credit card rates, in March, households finally hit a brick wall because, according to the latest consumer credit data published by the Federal Reserve, the last month of Q1, total consumer debt rose by a mere $6.274 billion, which is not only nearly more than a 60% miss to the consensus estimate of $15 billion. And this big drop is staggering because, again, in a debt-based economy, you need an expansion of credit to fuel consumption. And you think about this from, of course, an economic perspective, from a political perspective. What the current administration needs is the economy be growing by the election. What this data now suggests is we're about to see a crisis that we haven't seen since 2008 and 9. And as we look at real gross domestic product, real being inflation adjusted, that in blue, here you can see total consumer credit owned and securitized, that in red, and you can see decelerations in consumer credit also line up with a deceleration in GDP growth for good reason. When consumers are not demanding as much credit or cannot access credit, they can't consume, and that means the economy is going to slow down at a time when the political elites have been championing just how great the GDP numbers are. Well, that's going to change in a big way over the coming quarters. But when we are looking at the details of the report, we find something remarkable. While non-revolving credit rose to a modest $6.1 billion, up from $4.3 billion last month, and exactly half, this is a big deal, of the $12.2 billion average monthly increase in revolving credit over the past decade, what you start to see is that when credit growth slows, well, that means you're likely headed into a recession. Because again, it all comes back to the ability of consumers to spend money. If they can't access credit, well, it means they're not spending money, and that is a problem. They're not buying goods and services. That leads to less demand. Of course, that means higher unemployment. And this is notable because when we see student debt continue to shrink, as, of course, the Biden administration cancels loans, we also note that auto loans are barely rising due to record interest rates. So here again, you see the fact that even though we're getting rid of debt from people, it's not translating into economic growth. And then from the auto market perspective, higher rates are chasing customers away. And this is an issue. Again, you look at a debt-based economy, everybody right now believes rates need to go higher. The problem is higher rates are actually crushing credit growth as people walk away. What it's telling us, and should be telling the Fed, who's not paying attention, is that rates are actually too high. But something that should be high and rising, that's your trading account. Let's take a look at this recent data. This is over the last 2 months, from March 11th to May 7th. If you took every trade that we showed you, every original trade every week, you'd be up 85% if you had CTA Time Pro. 80 on Momentum Time Pro, you'd have an 81% win rate. That means you don't even have to be an expert. You just have to take the trades and you'd be up making money. And remember that big trade that I didn't tell you about? Well, here it was. As of the close of April 30th, here was wheat was triggered on March 13th, 14th, and 19th buyer reports. This is how much you'd be up. And here's the best part. You don't have to be an expert. We show you videos on how to put the trades in. We show you where to put your stop loss levels in. And unlike my friends who only give you a 50% discount on the first month, we give you a free month because we know this will change how you trade, how you invest, how you make money. And we even give you tips on how to manage your biggest asset. That's your 401k and your retirement IRA. Because right now we're seeing a deceleration in total compensation growth, and this is all back feeding into the economy. So we look at why consumers can't access credit. It's not just due to the banks, as we talked about yesterday. They just are losing their appetite to spend because after just getting ahead of inflation, we're seeing continued downward spiral. As we look at average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, or total compensation against the consumer price index. And right now the issue is interest rates on debt are so high that consumers, in addition to high prices, are not seeing enough sustainable wage growth. They're not getting enough hours, and that means they're facing an issue where they don't want to go out and spend and charge money because they're not sure if they can pay it. Of course, there's some other factors here as well. The biggest shock in today's data was the absolute collapse in revolving credit growth. This means your credit cards, which plunged from 10.7 billion increase in February to one of the biggest monthly prints on records to barely positive at 152 million. This is that breaking point we talk about as the smallest increase since the COVID crash. And since many Americans use credit to buy, well, almost everything when they go shopping, the fact now that we're seeing such a small increase in credit tells us that U.S. consumers likely have hit a wall. And there's some other factors here. It's not just due to the fact that banks are tightening lending standards, which is a factor. It's other ones, as you're about to see, which is not good for the U.S. economy, because if consumers don't spend, well, that means we don't see growth in retail sales. Without that, we see an increase in layoffs, and that does not bode well for the U.S. economy through the rest of the year. Of course, with the Fed refusing to cut rates for good reason, we'll show you why they should be cutting. The brutal slowdown in new credit card debt is hardly a surprise, since the Fed also reported that in Q1, the average rate across all commercial banks and credit card amounts just hit a new record high of 21.59%. So here's that other factor. You start to see consumers are paying massive costs and interest on their debt. It's weighing into their discretionary spending, and they're looking at their wages, their hours worked, and they're saying, you know, stuff I'd love to buy, but I'm not sure I'm going to be able to pay on it, particularly since the interest on my debt continues to go higher. And one of the issues the Fed doesn't see here is this deceleration or lack of demand in credit growth means that they have artificially set rates too high. And this all comes as a vivid reminder that while banks are happy to hike rates, if they ever really cut them, it's one of the main reasons why Goldman's trading desk just went bearish on U.S. consumers, and for good reason, because what we can see here is when we look at total consumer credit owned and securitized, as shown in red, against the federal funds rate, it starts to make perfect sense. When you see decelerations in credit, that means rates are too high to sustain demand. And what do you notice? That in each of these instances, the Fed is actually cutting. Here you see a big deceleration in total consumer credit. And what happens? The Fed still says we need to stand pat. And that means, of course, we're likely to head into a recession. And this is that crisis that I believe the Biden administration is going to face in the coming months as they head into an election. This is not good news for them, and even particularly worse news for the U.S. economy, because many people who believe that they're going to hang on to their jobs through this, well, historically, it's not going to happen. And yet, with consumers even more strapped for actual cash and equity, the personal savings rate in the U.S. has collapsed from over 5% to 3.2%, the lowest since 2022, in just a matter of a few months. And so this, again, we talk about a breaking point. We see that in the credit card data. We look at the personal savings rate. So you think about consumers' perspective. They're struggling to keep up with inflation here in a big way. Their debt service costs are going up. And now all of a sudden they're looking at their savings and they're seeing it dwindle lower and lower, and that means it's time to cut spending. And when that happens, as you can see historically, as we look at the consumer price index shown in blue, down on a year-over-year rate of change against the personal savings rate, you can see in periods where consumers start to increase their savings, because of course they get nervous about that. What happens is you get a drop in the consumer price index. You see that happening typically heading into recessions, but you can see it in other times. Any typical increase in savings eventually leads to a lack of demand. And right now, when savings rates get really low, that tells us consumers are about to have a shift. And instead of seeing, of course, higher inflation, what it suggests is inflation rates are likely to come down, not only due to increased savings, but due to a decrease in the use of credit. But there's another reason here. Of course, consumers are shying away from their credit cards. Well, as we can see here, Discover and Capital One, their net charge-off ratios are just soaring, suggesting that many people are not only missing payments, they are not making them for months in a row. And that means credit card companies are writing off the debt in a big way. And if you're losing, of course, that spending power from those credit cards because you're delinquent, or of course you're getting charge-offs, that means banks aren't going to extend credit. If they don't extend credit, many Americans don't spend. And of course, then we can take a look at what's happening here in the auto market. We talked about how rates are too high. Well, here's further evidence as we see more demand destruction as bad loans hit record high, as used car prices suffer the worst bear market ever. Now, you may remember the subprime housing crisis from 2008 and 9. What's interesting here is we're likely to see, and I'm going to make the case today, a subprime auto crisis coming this year, and it's going to be far worse than the housing crisis because there were more car loans in terms of volume than there were subprime home loans. And I'll make this case even simple for you. For a lot of people, giving up your home means you give up a place to live. But you give up your car, well, you might have a second one or a family member that you can use theirs. And if you don't have a job, well, you'll have to go to work. A bear market in the used car market was confirmed in November and since worsened through April. At the same time, negative equity values. Here's the factor. Remember, the banks are holding these loans are hitting new record highs while auto insurance rates have soared. It's the most since the mid-1970s, again, cutting into discretionary spending. And while gas prices at the pump remain elevated, the environment to operate a vehicle is probably one of the worst ever. Just listen to Gen Z and millennial users moan about $1,000 monthly car payments and other absurd costs associated with driving. But the issue here is we saw a 14% drop in the Manheim Used Vehicle Value Index. This is one of the index's lowest prints since the first quarter of 2021. And as for the bear market, the index is down 23% from the high and falling. There could be air pockets given the rapid up move, but demand has been suppressed given high interest rate environment. And again, it comes back to the fact the Fed wants to cut demand. Well, they're doing it. And now what we're seeing is new evidence suggesting the U.S. economy hit an unexpected breaking point. Meaning, of course, the Biden administration is going to be in all-out crisis mode here in the months to come. As according to recent Edmunds note, 20% of new vehicle sales, get this, involving a trade-in that had negative equity during the October through December period, the highest level since 2021, meaning people are trading in cars, buying new ones, and are upside down even worse. In fact, negative equity values soared to a new record high of over $6,000 during the period, a massive 46% increase from late 2021. And this means, of course, when the drivers cannot afford their vehicles and they're upside down, they can't sell them, they're simply going to hand the keys to the banks. And the problem with the banks is their parking lots are going to turn into used car lot. And when they're upside down, someone's going to have to write down the loss. You talk about the banks having a double whammy here. We looked at commercial real estate, which we've been focused on, but you also see the subprime auto market ripe for a bubble popping. And then we can look at this lack of consumer credit demand. Well, it flows all over the world because when U.S. consumers cut spending, it affects other countries as well. As we see, German industrial production falls for the first time this year. Remember, everyone was getting excited that things were turning around there. We said, don't hold your breath on that one. As the March measure falls 0.4% in March, led by drops in consumer and immediate goods and energy. This is better than the 0.7% decline estimated. But the cyclical downswing has come to an end and optimism is back. Well, is it really? However, the road to a sustainable recovery, particularly in an industry, remains long. Now remember, they think this is just a short-term cyclical blip. It's not. It all comes back to the banks. Yesterday we talked about how the banks were tightening lending standards. We can now see that effect in the consumer credit data. But look at what it means for industrial production. And again, we're going to look at U.S. data, but you think about the U.S. consumer, they spend money all over the world. Here we see net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. Now remember, when the blue line is above that horizontal black line, it means on-net banks are tightening standards, making it more difficult for banks or for consumers and commercial banks or commercial borrowers to access credit. And look at what that means to industrial production. You see that red line takes a downturn. Now, mind you, industrial production is not shown here on a year-over-year rate of change, suggesting we're about to experience the same thing that Germany is starting to see. And when industrial production turns down, well, something else turns up, and that means more people are going to hit the unemployment line. And it's not just industrial production we're seeing this, it's the oil markets now as well. Here we see with this headline, oil drops with bearish U.S. stockpiles compounding weaker outlook. And of course, that means demand from U.S. consumers is dropping, and that's interesting. Now, even though we saw the Biden administration add to the SPR this week, look at this as we head into summer. School is starting to get out now in certain places around the country. Where we see distilled stocks up 560K, gasoline inventories up 915,000. This is odd because, again, we're seeing nice weather. We're seeing opportunities for people to travel and spend money. And what we're finding out is consumers do not have money at all. And when we take that same chart, we look at the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes, and we overlay crude oil prices. Well, everyone's bullish on energy right now. History says that when banks tighten standards and you have less credit growth, well, what it means is consumers have less money to spend, and that means energy prices coming down. Here we can see throughout history the big direction now for energy is indeed lower, not higher. And that all in turn means there's going to be a global dollar shortage, and that's not good for the U.S. economy as well, because that is the final breaking point. As ECB's Holzman says, the Fed is the gorilla in the room thanks to the dollar. And remember, the banking system creates dollars by lending. Right now, they're not doing that. In fact, they're destroying dollars, not a good sign, particularly as the government borrows record amounts of money. ECB Governing Council member Robert Holzman said the Federal Reserve's sway over the world's top currency gives it an outsized influence that policymakers will take into account. And to a certain extent, our data decisions are naturally influenced by the Fed. We don't operate in a vacuum. The Fed with the dollar, figuratively speaking, is the gorilla in the room. Because right now, without cutting rates, the Fed's going to drive the dollar higher. That's going to bring inflation down. It's going to send U.S. production to overseas suppliers. It's also going to send U.S. workers to the unemployment line at a time. The Biden administration, as I just showed you, is going to be facing an unprecedented and unexpected, more importantly, crisis in the coming months. As we see now, consumers have hit a breaking point. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.